morning all. Just a quick disclaimer before starting the webinar that whatever the stock ideas that we'll be discussing today, so that will be just for the educational purpose, and please consult your own investment advisor before investing in those ideas. So moving ahead, just to take you through quickly through the topics that we'll be covering today. So first, I'll be discussing about the current scenario, and then I'll be also taking you through some of the valuation points that we keep in mind while going ahead in the investing journey. And also my colleague Vijay will be discussing about some of the key pillars that will be propelling the India growth story in coming years. And also he'll be taking you through some of the investment ideas and how you can go about finding the multi-baggers. So Prabhu, if you can just move to the slides. Yeah, next slide, please. Yeah, so starting with the market cycles, right? So we all know that there are four stages to the economic cycle. The first is the expansion one, the second is the peak, the third is the contraction, and the last is the trough. So the market cycles, stock market cycles, basically coincides with the more or less with the economic market cycle as well. So the bear market typically coincides with the contraction, the trough phase, while bull cycle coincides with the expansion, the peak phase. So currently what we are witnessing in the market today, right, it's mainly the contraction phase in the economy. So if you remember last year when the inflation was quite high, so across the globe, the central banks have started to tighten the monetary policy in response to fight the inflation. And that has mainly led to the sharp rise in the yield curve across the globe, right? And which is, again, there is a withdrawal of liquidity, which has impacted the sentiments and again the flow to the markets. And then we have seen corrections happening across geographies, right? So mainly since it's a contraction phase, so we are seeing some of the very prominent signs that the liquidity is not there, and again the asset classes are being repriced because of the change in the discount rate, right, in a very negative manner. And we are closing onto reaching the trough now. So mainly the bottom of the bear market also coincides, or generally it comes slightly early than the trough of the economic cycle, basically because the market starts to discount the future quite early. So what our view is that we have been through much of the interest rate hike cycle. It's just the 1/3 of the cycle interest rate hike is remaining to be there. And again, like most of the news which have impacted the market, be it the inflation or the supply chain issues that have already been played out, right? So what's impacting the market today is just that the expectation of the slowdown in the consumption, right? So all the interest rate news and the issues that have impacted the market in the last year have already been factored out. It's just that the investors and even the business owners wanted to see the impact of those the tightening in the monetary policy, whether it's actually going to impact the sentiments and the consumption for the buyers. So that will be playing out in the next 2 to 3 quarters, and then we'll be through the bottom of this economic cycle. And from there on, we can look on to achieving the new peak of the markets, right? So this, if somebody is entering into the market with a view of 3 to 4 year time horizon, I think this would be a very ideal time to enter into the market, right? Because this is the time where you can find the bargains in the market. And again, the money that one made, or the investment that one made in the bear cycle, it's basically goes on to become very it goes on to make very decent returns for the investors there on in the later years, right? So we have some creatives for you to discuss. So if you can just move to the next slide. The main concern is around the bear market, right? So what could be the length and how severe it could be. So in the first half of 2022, we all have seen that the market has corrected by almost 16-17%, right? In fact, 18% in the period from January to June. It was a very severe and swift fall that we have seen in the market, mainly because of all the external factors. So, and again, in the second half of the year, we have also seen the recovery happening and Nifty reaching all-time high. But if you can just look at the past bear cycles as well, so what we can see that the bear cycles are normally very swift, right? It doesn't take much time for the market to make a bottom. So now the bottom is normally in place whether between 3 to 6 quarters time frame, 9 to 15 months normally what market takes to make a bottom. And the bottom is basically whenever the market is towards the market is actually in line with the trough of the economic cycle, right? So whenever that happens, the market also makes a bottom, and then from there on, market starts to reverse. So what we can take heart of the fact that the market started to correct, but it didn't correct much, and there were some factors in place which actually propelled the market from the bottom of June to current closer to all time high levels. So uh, my colleague Vijay will also be discussing those factors in detail, but I'll just take you through some of the key factors in the next slide. So Prabhu, if you can just move to the next slide, please. Yeah. So what we can see here is that the divergence between the Indian and US markets, right? So in the past 15, 17 odd years, right, we have seen that the Indian market has moved in high correlation with the US markets, right? But what happened in the 2022, the divergence grew very sharply in between these two markets, right? So the fall in 2007, 2014, and in fact 2017, 18 was quite in sync with the US market. But in 2022, when the US market is down roughly around 22%, the Indian market is already making highs, right? So mainly because of the fact that earlier we were quite dependent on the FDIs, right? If I have to break the domestic flows for you today, so mainly the market receives around $7 billion from the EPFO side, 13 to 15 billion from the insurance side, and then a very resilient SIP mutual fund flow, which is contributing around 15 to 20 billion dollars to the markets, right? So roughly we have an inflow of 35 to 40 billion dollar coming every year, which is going into the large cap names. In comparison, if you look at the maximum FPI, FIA investment that we have received in the year 2020, when there was abundant liquidity, that was just around $25 billion. So even if we have to take away all those liquidity, the domestic flow is strong enough to counter that volatility in the market and to counter that selling in the market. So that's again one of the reasons why we have been very resilient in the wake of FIIs and FPIs outflow, which is again a hot money, and that's very good for the markets in the long term. The second is the inflation factor. So basically, while the global markets were seeing inflation at 40 years high, we have been seeing inflation, which is not new to us. And in fact, not very long ago, 5, 6 years back, we used to have similar kind of inflation numbers. So the businesses here are equipped, the consumers have the mindset, right, to take out, to go and take loans and operate business on the credit side. So that's why we have also seen the credit growth happening at a very faster pace, around 16% in last year, when we are in the interest rate hike cycle also. The third is the fundamental. So all of the variables that have impacted the market last year. So mostly the variables are exogenous variables. Very few company specific variables have impacted the businesses last year, and one could be the margins that have started to deteriorate on the back of high cost prices, but that has also again going to be normalized next quarter, or in coming few quarters, so that won't be a problem anymore. So, and again, the inflation which has impacted the market in last year, it won't be a bigger problem now, right? So all those variables which have kept the market very resilient to the volatility, so those are not just the one-offs in the market, right? That will be keep on contributing to the market in coming years ahead, right? So these are some of the structural changes that have happened and kept the market robust against the global slowdown. So now that we know about the markets are divergent and it's acting on its own. So let's see whether equity as an asset class is placed better to the debt. So, we are hearing a lot from our investors that they wanted to move to safety and they like the surety of returns that a fixed income can do, right? They are very happy to hide against the 7 to 8% kind of FD returns that the FDs are giving, or 10 12% kind of returns that the bonds are making. So at least there is a surety that over the next 2 to 3 year time frame, they are going to make this much return, right? But the thing is that these are the times actually when investors can park their money and can reap the benefit of the lower levels and valuations which is present in the market, right? So we use a model to assess whether the market is actually attractive or not so attractive. And if you look at, so basically we use a spread called Fed spread, or Fed curve. So mainly it's nothing but the ratio of Nifty's forward earning yields versus the 10-year G-Sec yield. So whenever this curve is at the bottom, it means that the equity is not that attractive. But whenever it hits that bottom, then from there on, it starts to move up. And when it will be moving up, that will be the time when the equity will be giving a maximum return. So you can't go and make the investment when the curve is at peak, right? You have to make the investment when the curve is at the bottom. And if you look at the curve where it is ending now, so it's at the lower level of its all-time lows, right? So from here on, if it starts to move up, then slowly the equity will be more attractive and everybody will jumping to the bandwagon, and the equity will starts to become more expensive then, right? So if somebody is coming with a time frame of 3 to 5 years, so obviously nothing against debt or fixed income. They are again a very good avenue, and investors should be allocated to their asset location, whatever it is. But if somebody is just taking out the money from the equities and feeling that the volatility is too much to handle, so this won't be for long. And from here on, the attractiveness will be very much high if there will be a further correction in the markets. Now moving on. So let's just also take on the Prabhu, if you can just move to the next slide, please. Yeah, so let's also take how the different market capitalizations are placed today, right? Thanks to the robust flows from the EPFOs and the insurance companies and the SIPs, the large caps remained very resilient in the entire downfall. And if you look at the current levels of valuation for the large caps, so we are somewhere at close to the 10-year average levels, right? So we can say that the market is not very richly valued thanks to the consolidation that we have seen in the last 1 year. But again, the undervaluation is not there, right? So the nominal return that one can make in the large caps is not very high, but obviously the returns will be made in that space as well. Now coming to the mid caps. So again, mid caps are trading at the long-term average. But there are, since we are the fundamental stock pickers, we can find out some of the businesses which can be a very good opportunity to make money. So mainly the money where mid caps where the money can be made in the mid cap space is the companies which can go on to become the next large caps. And we have seen happening with the multiple companies from the mid cap space when they cross a threshold of 25,000 crore market cap and go on to become a 50,000 crore company. So again, they see some good inflows coming from the passive side, right? And that will add on to the more returns there. So we have to be very selective while investing in the mid cap names. We don't want to be index investor and be passive about it. This is a space where you can be very active in terms of stock picking. The last one is a small cap, right? So a lot of concern around the small cap space, and that's quite evident also in terms of the valuation that we are seeing. So if you look at the current valuation on the trailing 12-month basis, the index is currently trading at 16p, while the 10-year average is 34. So it shows the kind of carnage that the small cap companies have seen in last 1 year. So the entire growth of 2021, when the index itself have become 2.5x from the COVID bottoms. The entire froth has gone now, and the companies from the small cap space, selective companies, have started to look very good. But one has to be very, very selective about investing in those companies. And what our view in house is that you can probably start to identify those companies, start investing in a very small manner, but wait for at least 2 to 3 quarters, right? Because we are seeing those companies performing on a quarter-on-quarter basis. But again, the street expectation and the street acceptance of those numbers, it will take some time, right? So when we are in a situation where there is so much panic around, so companies got hammered even without any reason, right? And we have seen happening that with the portfolio companies as well. But when the market situations turn around, these are the companies which are going to be the first one to move ahead in the pecking order, right? So one has to be very selective. But if one is coming up with a horizon of 3 to 5 years time frame, so again, this is a very promising space. Not today, but maybe wait for 3 to 5 months to start your investment in staggered manner. So moving on to the next slide. Now, so there is a lot of debate, right? So whether we wanted to invest today, or should we want to invest after some point of time? So what we have seen, right, that all the past falls that have happened. So the severe falls that happened from a peak level of valuations, right? If you look at the bucket, right, if the Nifty P is less than 22, the 3-year performance of the Nifty improves rapidly, right? Whenever the valuation is from 20 to 24 or 24 to 26, which is again slightly on the higher side considering the historical valuation numbers. So the performance of the Nifty kind of moderates, right? So that's why if you look at the current valuation number for the Nifty also, in this quarter we'll get some opportunity to invest, right? There will be a volatility on the back of demand slowdown. There will be a volatility on the back of some budget announcement, right? So we can utilize this volatility to find out the right point to enter into the market, so that we can also take benefit of the price correction going forward, right? So the current valuations are good, but it's not that lucrative. A slight fall in the market, maybe a 5 to 10%, will make the equities very attractive from this point of view. Yeah. Moving ahead, Prabhu, please. What we have also done the analysis that people feel very comfortable investing in a trend market, right? So they wait, they try to get out of the market during the entire consolidation phase, and then try to come back when the market has closed the previous peak, right? And it's in a trending manner. So basically, you can do that, right? But if you just remove one outlier returns, right, from 1991 to 1994, the returns have been pretty dismal, right? It is just like, being double digits, lower teen digits kind of return that one can expect to make. But if you have the guts to be there in the volatility of the entire consolidation period, right, and invest at the bottom also, so the returns can be exaggerated quite a high, right? So basically, we can see that the returns from there on, if we are not just investing at the bottom, but even at the consolidation phase, when the, let's say, the Nifty has consolidated for the last 1 year. So if you have just invested in those entire time frame, utilizing the market the volatilities, so the returns could be higher, and it could be even more than the higher teen digits. That's what the historical analysis of the market shows us. And a very good analysis is that, if you have invested in all days, and if you've invested, let's say, 100 rupees, like around 30 years back, 30 odd years back. So that 100 rupees, it will have grown on to become 75 lakhs rupees. If you have just missed out the 5 best days of the market, that has gone down to 62 lakhs rupees. If you have missed out the 10 best days of the market, it has gone down to 50 lakhs rupees. And if you have just missed the 50 odd days, so the return would have just be the 20% of what you'll be making in the market. So it's very important to be invested at all point of time. It's just that you can have the leverage of 5 to 15, 20% kind of cash that you want to be on the sidelines, have some dry powder ready to allocate when the market is falling, right? But it doesn't make sense to wait out on the volatility and try to come back when the market is rising. So the investors only make money when they're invested during all the time horizon, because nobody knows and when the market is going to reverse, and timing, how to time it. So the best way is to be invested and just have some dry powder in your hand, so that you can be able to deploy when the market is volatile. Now that we know that markets, we have to be invested in the market. So let's quickly assess some of the factors in the next slide, which have impacted the market in 2022, and how they are going to be in the year 2023. So the first and foremost is the inflation part. So the inflation has been a very scary issue for the investors in last year, right? We have seen the crude at 120 odd levels, 125 odd levels, and now we have seen it moderating to the $80 odd level. So what we see that the inflation, whatever the print that is coming for the US market as well as for the Indian markets, that is going to normalize on the base effect, right? So we don't see the commodities at the same level. We don't see the crude at the same level. We have seen the supply chain issues shortening out. We have seen much more easier trade coming from the China on the China reopening side. So because of all these things that we have seen happening in the last 1 year, the inflation expectation is going to be very moderate in 2023. The interest rates, we have already through the 2/3 of the interest rate hike cycle. It's just that 1/3 of the tail hike is remaining. But again, this is more or less factored in, and we don't see any inflation surprise that will again trigger a higher interest rate expectation going forward. So again, this has been taken care of. The third is the growth rate, so that we all know India will be growing at a 12% nominal GDP growth rate for next 4 to 5 years time frame. So that's not a problem anymore. Dollar index, which was again trading at 124 odd levels last year, right, and which has led to exodus of capital from the emerging markets. It has again retraced to 104 levels, and it is expected to go below 100 levels in this year, right? Once the Fed or will start to cut the interest rates there, right? Or it will start to stagnate the interest rates there. It will start to go down to the 100 levels, and that will be very good for the emerging markets, because this is the time when we see the inflows start to come back in domestic markets. So all those factors remain very positive and buoyant for the market. we see that the market could be domestic market mainly because of some internal worries now, mainly because of the demand slowdown and all. It's going to consolidate for quarter one for this year, and quarter two maybe again at a stretched. But quarter next half of the calendar year will be going to be a buoyant one for the markets. And I will hand over the session to my colleague Vijay now. We'll be taking you through some of the key drivers of the economy and how they will pan out in the future. So over to you, Vijay, now.
Yeah, thank you, Prabhat, and thank you for taking us through the market cycle and how the landscape has changed across the valuation and other parameters. Uh, Prabhu, we can move to the next slide. Yeah. So now we have like better understanding of the market cycles and how they work and where we are currently. So we will look at the some of the parameters or the some of the key pillars which will be forming the next bull cycle. So as Prabhat has highlighted, we are expecting the market bottom from the global equity side and in our market as well in the couple of quarters. We are also looking at the some of the pillars which are already in process, which will build the next bull cycle. So what we have done, we have identified the key 5 pillars which we think are going to be the drivers of the next bull cycle. So the first one is the loan book growth, and this time we have seen our loan book growth almost touching the all-time high in the last 10 years, almost going to 17.2% year-over-year basis. And if we look at the nature of the loan book growth, so it's a quite broad. So normally in the past credit growth cycle, the some of the parts have been doing good, but some of the past parts were not doing good. So if you look at the left side of the chart, the sector credit growth, so this time the growth is broad based, taking from personal loans or services side to the industry side, or even the agri or the rural demand is growing very well. And because of that, the nature of the credit growth is very vibrant this time, also widespread, not a like a divergent one, but it's a uniformly spread across the various regions. Second part is the rise in manufacturing activity. So what we have seen in the recent government, the government have been very pushing significantly to the increasing the manufacturing share in the GDP of India. So right now, the manufacturing sector contributes around 15% of India's GDP, and government is aiming to bring it around 25% of GDP in the next 3 to 4 years of time frame. So this is what like the government has kept in mind, and it has also increased the manufacturing activity in India. Which is also closely connected with the revival in capex. So if we look at the center's capex, so the capex has been rising from the government side, and now it has almost touched to the 2.9% of the GDP. So if we look at the current capex, that is projected to touch around 7.5 trillion INR rupees, which is the all-time high for the economy. And we are expecting that it will continue to grow in the growing manner in the upcoming 3-4 years as well, and which will help the capacity utilization, which is already 75%. Fresh investments are also expected to come from those sides, from the private player side as well as from the government side. And government has been the leader this time, at least in the capex revival. Along with the PLI schemes, the government has been pushing very hard to the manufacturing sectors particularly, and they have already outlined the capital outlay of around 1.45 lakh crore to the various industries like auto, pharma, telecom, solar energy, renewable energy kind of various sectors. So the government has very vibrant around pushing the manufacturing and improving the ease of doing business across the various industries. And the last one is the China Plus One. So we have been, we all know about the China Plus One, which was there from 2015. But this time in the 2021 or 2022 crisis, when Ukraine-Russia war broke out, so people also started to realize the supply chain issues coming from the Europe side and all the industries which were present in Europe. So the global manufacturers also started to diversify their sourcing models, and they have also started looking out for the new emerging markets. So they also don't want to go to the China because of the various regulatory issues and the various kind of mistakes that China has done on their part. So the India has become quite attractive destination for us. And if we look at just the 3 years ago, we were exporting around 22 lakh crore of goods to the world. Now we are exporting around 31 lakh crore of goods. So in the last 3 years, we have jumped our exports to the 50%. And this is the mainly the result of the various initiatives that government has taken along with the private sector pushing for the capex side. So these are the 5 fundamental pillars which will keep driving the economy upwards even for the next decade, and that will also increase our GDP, and naturally it will also reflect in the market capitalization of India Inc., which will also increase in line with the GDP growth. So, but also along with that, there are some medium or short-term factors which we think are which will dominate at least for the 2023. So please move to the next slide. Yeah. So the 2023 will be the pre-election year. So we are going into the pre-election year with the start of this year, and government normally spends heavily a year before to get the upper hand in the election side. So government has also already started increasing the capex, as we have seen that it has almost reached to 2.9% of the GDP, which in turn will also help the rural consumption to picking up, and also the global supply chains have also started to improve, which is also evident in the cool down of the commodity cycle. So if we look at the Bloomberg commodity index, which was at all-time high around 9-8 months back, now it has come down to the 6 months low. So the global supply chain has also started to improve, and this has also led us to the moderation in the inflation, as Prabhat highlighted. So we have been sitting around 7.5 plus inflation in this year, in the previous calendar year 22. But for the last month, if you look at, the inflation has come down to the 5.88%, which is in the range of the RBI guidance or the tolerance range. So we have successfully defeated the inflation. At least we have brought it into our tolerance zone before it we bring it down to the 4%, which is our mean reversion level. So that is a clear divergence, which also is reflected into the June to December rally, which we saw in the Nifty. So the low inflation and the low cost which will be coming through the inventory side, we can expect the market share gain from the quality company side, mainly because that will also lead to the expansion of the margins or the normalizing of the margins which were impacted in the calendar year 22. So that's why we are very hopeful that once the base effect starts to kick in, H2 can be a very good for the Indian market at least. So these are the factors and more or less the long-term trends that we think that will drive the next bull cycle, in our opinion. But we also need to understand like how the which sectors will get disproportionate benefit in this upcoming economic cycles, because each cycle will have its own new leaders which are coming from various sides. So for that purpose, we have done we have studied the various developing and developed economies, and we have tried to take the analysis to the forward that how we can apply to the India Inc. side. So please move to the next slide. Yeah. So so in this analysis, what we have done, so basically we have plotted the years of economic progress versus the GDP per capita. So currently we are somewhere around $2,400 per GDP per capita region, and we are moving towards $3,000 per capita, $5,000 per capita in the medium to long term, and in very long term we will also reach $8,500 where US and other developed economies are there. But that will be in the, let's say, the decade plus kind of long term horizon. But if we look at the next 4 to 5 years of horizon, so we will be crossing the journey from, let's say, 2,400 to 5,000 odd dollar. So what we have seen the developed economies, when they were going through these phases, there were disproportionate benefit coming to the main 3 sectors. First was the credit sector, second was the retail sector, and third one was the real estate side. So why this is happening? So what we have gone one more step down, and what we have seen normally when GDP per capita crosses the $2,400 mark and reaches to $3,000, people the participation in the employee force starts to increase from the female side, and females will start to let's say match up the size of the men, the male manpower into the overall employee force, and that will lead to increase into disposable income on the family level. So that will trigger the spending from the family side, mainly from the home buying, or let's say they are buying the new, let's say new clothes, mainly the official clothes. They are also buying the laptops and the electronic goods like such as mobiles and various extra various stuffs which are helping them to propel their official work and career growth. So these are the things which propel the growth in particularly these sectors very disproportionately versus, let's say, we are talking about, let's say, the pharma or IT. So we are quite optimistic on these three sectors, mainly the tailwind coming from the personal disposable income growing side. So now we have clear understanding that these are the three sectors that will get disproportionate benefit. So now we will also understand that how we can pick some of the emerging leaders coming from this sector side. And for that, we will take you through our internal robustly developed formula that we have mastered over previous bull cycle. And we are trying to apply it to the in this bear market. We are trying to apply it to find out the next emerging leaders of the next bull cycle. Yeah, please move to the next slide. Yeah, Prabhu, we can move to the next slide. I think there is some issue. Prabhu, we can maybe reshare the presentation.
Yeah, Vijay, I will be sharing.
Yeah. Yeah. So quickly to the framework that we have developed. So what we have done, so over the last bull cycle and the starting from the March 2020, we developed this framework, and we also applied to find out the emerging bull leaders for the previous bull cycle, and we have been very successful across that. And also we are already applying this framework to find out the next emerging leaders. So before we move on to the themes that we liked and we have already started like putting in our portfolio, we will also spend time first, like how the business creates value or net worth for the individual investors, also for the minority investors. So we need to go to the basic level. So when we are buying a share, so we need to keep in mind that we are buying a piece of small piece of business, which is just a sharing in the profit. So any business, if they compound their profit, let's say they double their profit in the next 4 to 5 years, our stock price will also go up to the 4 to 5 years, in double in next to 4 to 5 years. If our earnings are not doubling, let's say in the next 4 to 5 years, and our stock price is going to is doubling, so it's not sustainable. So we need to understand the stock price performance is just reflection of the underlying earnings, nothing else. It's not the other way around, that the stock price is depicting the earnings growth. It's not like that. Earnings growth are the dictator of the how the stock price will look in the future. So normally we try to find out the companies from the various industry which is growing better than the industry growth, and which has potential to double the earnings in next 4 to 5 years. The second leg is coming from the valuation side. So as Prabhat has highlighted across the various market capitalization, the small and mid caps remain quite attractive, especially small cap, which is available at the completely discount level. So we deploy our energy over there, finding the new names which are not discovered by the street, which are trading at the undervalued in the undervalued zone, and also they are trading at to the discount. To just give an example of the valuation of our one of the small and mid cap portfolio. So let's say if the industry valuation is somewhere around 1x, 1 year forward of around 40-45x P, the leader normally trades at 70x or 80x P, but our portfolio companies, which are the emerging leader, trades at 25 to 30x P. So which gives us the enough margin of safety versus the industry and also the industry leader. And also it has a higher potential to compound our clients' net worth, because the wealth creation will happen from the both side. Profit will also double in next 4 to 5 years, and also the valuation will improve, let's say from 30x P to the 60x P or 50x P. So almost double of the capital will also come from the value side. So if we multiply the 2x profit growth and 2x valuation growth, so it should close to around 4x kind of portfolio return on the particular company. So that is how we pick our emerging leaders in our portfolio. And we also remain cognizant of the fact that normally when we are betting on the emerging leaders, 20 to 25% of the thesis will not play out as per our initial investment thesis. So even if the 25% of the portfolio is not going as per our thesis in next 4 to 5 years, at least 75% of the portfolio will, let's say, double their earnings, and there will be some valuation re-rating. So it has a healthy chance of doubling the portfolio earnings and the portfolio in line with that in the next 4 to 5 years to at least close to double. So that is how we mainly focus on the portfolio earnings growth and also the valuation upside, which can kicking from the undervalued segment. But when we are applying this formula, we need to keep some things in mind. So before we go into the individual themes, I would like to highlight some of the key things about the market or the nature of the market. So at RH, we always keep these three things in mind. So first one is that market always moves in the cycle. Okay, so as we have seen, as Prabhat has covered in the first and second slide, currently we are in the bear phase, and any investment which we do in the bottom leg of the cycle will have like disproportionate benefit when we go to the upside of the cycle. Second thing is that every bear run brings along the new bull cycle seeds, and the next bull cycle will have always different leaders compared to the past leaders. So if I have to demonstrate the example, like in 2020 when COVID came, so what we have seen, like there were around 30% sharp fall in the across the global indices, but that also brought some opportunity in terms of pharma sector doing well, digitization spreading across very quickly, and we have seen the massive re-rating happening into the IT stocks, be it Infosys or TCS or some of the mid-cap companies like LTI or Mindtree or name it, other companies from the IT segment as well. And also we have seen massive re-rating happening in the pharma side. But this time when the supply chain crisis came in from the Ukraine and Russia war, and also when the COVID started to take backseat, all these things started to become laggard rather than the leaders of the bull market. So similarly, if we look at the last 20 years of data, what we have seen, the 2004 to 2008 bull market was led by commodities, capital goods, BFSI side. 2009 to 2013-14 bull market was led by the IT and pharma. 2014 to 2019, up to 2018, the bull market was led by the consumption stories, BFSI stories, and various consumer retailing stocks. So this time, as we have highlighted in the key pillars, there are the three different industries which in our opinion will be the leaders, or let's say getting the most benefit from the India growth story. The last one is that the stock market never gives return in the uniform manner. So what I mean by that, so when we are investing in the fixed deposit, so normally, let's say if we take example of Indian any public sector fixed deposit, which is giving, let's say 7 to 7.5%. So our capital will always increase by 7.5% each year. So let's say if we are investing for the 5 year, we will get 7.5 each year, first, second, third, fourth, fifth year. But market never works in that manner. Market always will move in a cycle in the cyclical manner. It may give 1 year, let's say the 100% return, second, third year, it can be -5 or -10 as well, even -20 in some cases. But fourth and fifth year can be quite drastic, like 40% or 50%. So if we compare the current scenario, like I mentioned in the previous discussion, that the formula which we applied for the previous bull cycle. So the market has been very severe for FY22 of the first half, when the stocks and indices fall by 30%. But similarly, in the recovery phase of the late 2020 and 2021, we saw the 30% recovering for our portfolio, and from there we almost went 2x. So we essentially went 3x from the bottom of the 2020. So if one looks at the past, so one will see the growth opportunity at the bottom of the 2020 cycle. But if we were present in 2020's bottom, so we might be very scared and worried that our portfolios are down 30%. But we should always remember that the things start to improve once the even the some light at the tunnel appears. And whenever that recovery starts, so we don't only the market doesn't only reward the recovery, but it also creates additional net worth upon that. So for this year, we have seen like most of the portfolios are even on the indices or flat or maybe 4 to 5% kind of down. So it may happen in the recession, which we are expecting from the US side, which can be a very short-lived recession and most predicted recession. So we may expect some volatility, but this will also increase the probability of producing abnormally high returns in the next few years, because the profit has been growing, our GDP growth has been growing, but the market capitalization has not moved on. So the market has a lot of to catch up from small and mid cap space, at least with the India's GDP growth. So with these things in mind, we have identified some of the emerging leaders, and we would like to highlight those with our underlying investment thesis, what we think, along with the GDP per capita graph, which we shown. So basically, we have highlighted three leaders from the three various segments. The first one is from the PVC pipes, which is a building material. So we are playing the real estate theme from the building material side, mainly because the what we have seen in the past with the some of the real estate names. So there is a working capital crunch, and also there are multiple issues with the order execution or the, let's say, the project execution side. So we don't want to be trapped or fall for those traps, and we want to play the real estate theme to the building materials, which have a very good working capital, very good ROC numbers, and there is no issue of like recovering the money of the project execution delay kind of things. So Apollo Pipes has been the emerging leader. So Astral has been the leader PVC and CPVC segment for almost a decade. But if we compare the price performance and the TTMP, so it's the sales has been around 20%. But if we look at the Apollo Pipe sales, it's around 30 odd percent for the last 3 years. And the price performance is also in line because of the lower valuation. It has got almost generated 60% more return versus the industry leader. So that is coming mainly from our multi-bagger framework. So the sales doing better versus the industry leader, and also the valuation is quite reasonable if we compare with the industry leader. Second theme that we have picked is from the paint segment side. So the Asian Paints is the leader in the Indian decorative paints segment side, and it has been a very consistent leader for almost 2 decades now, and it has been growing its revenue by 14 odd percent in the last 3 years. But if we look at the new leader, which is mainly coming from NCR region, Sirca Paints in the wood coating side, so they have been growing their revenue at a 19% CAGR. So to share an interesting story about Sirca Paints, so in 2020, when we onboarded the stock, there was a fire incident at the Sirca Paints, and the stock was almost down from 300 rupees to 200 rupees. And it was almost at lower circuit when we started to pick in our portfolio. And it was a very attractive entry point. It may look like the production will not happen for a quarter, and people started to feel jittery. The stock almost collapsed by 35%. And that's where we get our chance to started building the position in the Sirca Paint, and which has worked out very well. And it has almost generated 173% return in the last 3 years versus the industry leader generating around 36%. And still, if we look the valuation arbitrage, it's very significant. It's almost at 40 odd percent discount versus the Asian Paints. And the last but not the least is the wires and cable segment. So Havells has been a leader in those segment, mainly in the FMEG side and also the wires and cable space. But Polycab has done instrumental work in gaining the market share, especially in the cables and wire segment, and now almost becoming the leader in that particular space. And it is also available at a reasonable discount to the industry leader. It's around 60 odd 40 to 50% discount, trading at a discount with the P, and also the earnings growth has been very good versus the almost 30% higher than the Havells. And it is also reflected into the stock price performance for the last 3 years of 170% versus the 40%. So we think that these themes have much more steam left what they have done compared to what they have done in past. We have just seen, let's say, the 20% of their overall potential in the last bull cycle. And we think that any volatility which will be coming from the US side or some of the global issued side, we will also put some more dry powder into those names, and we are quite optimistic from next 4 to 5 year perspective on these names. But we also need to keep in mind that the journey of next bull cycle will never be easy. It will have its ups and downs, but it will be a rewarding one. So before we move to the conclusion, so we would like to put some of the key takeaways that we have highlighted in the last slide. So please move to the last slide. Yeah. To summarize what we have discussed in this particular session of Right FinTalk series. So mainly the key takeaways are like the market will always move in cycle. Averaging in lower levels will always generate disproportionate return, which will also optimize our overall portfolio return. In the current scenario, what we are expecting, like there are lots of job cuts happening in the US side, and we are expecting that earnings downgrade will follow in this quarter, maybe the Q3 and Q4 of the financial year. And for the upcoming 2 quarters, we can expect some bottom out happening in the US market, which will also mark the end of bear cycle, in our opinion, for the Indian market, and we will move to the next phase of our next bull cycle. So any volatility that is coming from this side, we should always use it to top up our investments, and also start focusing on the emerging leaders. So as we have highlighted the emerging themes like building materials, mainly from real estate side, or the credit growth side, or let's say the retailing side, because of the higher participation from employee force increasing mainly from the female side. So those things one should keep in mind and start deploying or start picking up those names in the portfolios when one is looking at the bigger picture of India growth story. And in long term, if we look at the past, like in 2020, one must have been very scared when the portfolios were down around 30% in a single month. But if we look at in today, in hindsight, it's remains a quite attractive opportunity for the previous bull cycle. Similarly, the current bear cycle has seeds of the next bull cycle. And when we will look at this bear market from 2025 in the hindsight, it will also look like a blip. So all we can do is we can fasten our seat belts and deploy whatever dry powder we have in our India growth story. And it will not be an easy journey, but it will be a very handsomely rewarding one. So that will be it from our side. And over to you, Prabhu. Yeah, thank you.
Yeah, thank you, sir. So we'll start with the Q&A. So the first question is, what are the few sectors to look forward to in 2023?
Yeah. So as we have highlighted, so whenever we are looking at the emerging sectors of every bull run, so every bull market will have different leaders. We have seen in the last 20 years, different sectors leading the different bull cycles, and different bear cycles are also led by the different laggard sectors. Like this time, IT and pharma has been one of the worst performers. So similarly, for the next bull cycle, we also studied the various developed countries which have already crossed the journey of 23 or 2400 GDP per capita to 5,000 odd dollar GDP per capita. So in our opinion, we have highlighted those three sectors, mainly the retail consumption, which will have tailwind from the workforce employee growing. Second can be the credit growth, because people are buying houses once they attain certain personal disposable income. So that is also beneficiary. Whatever building materials are used in building houses will get disproportionate benefit. And the third, what we think is the electronic goods retail can be a one which will be very attractive, because people will be spending more on the laptops, mobile side, and people also mainly from the tier 2 and tier 3 cities. We also interact with a lot of dealers on quarterly basis, where we meet a lot of dealers and have con calls. So what feedback we have received in last 1.5 years. So normally the rural consumption has started to pick up, and tier 2 and tier 3 we are expecting the disproportionate sell coming on the electronic goods side, because the workforce is coming also from their side to the urban population. They are transferring from rural to the urban side. So we can expect like these three sectors doing quite well in not even in 2023, but even 2024-25. So whichever themes that we are picking in our portfolios, and whatever we are highlighted. So those are not the short-term trends, because at RH we are not looking at the short-term markets. We are only utilizing the short-term volatility to pick the long-term trends. So we are not investing in particular segment for a year or 2 years, but we are investing with a mind of 4 to 5 years. Yeah.
Yeah, thank you, sir. So in the past few webinars, we have been talking about the banking industry. So how do you see it play out going forward?
Yeah. So we have all seen like the RBI is very RBI has very quickly raised the interest rates, and we have seen almost 200 basis points hike from coming from the India side as well. And what we have seen, like the lending rate from the bank side have increased very quickly. So all the banks, let it be the private sector banks or the public sector banks, they have increased the lending rates to the customers, but they are very sharp. They have not increased the deposit rates in line with the advances rate. So majorly the private sector banks, they have been at least fair in this region, and like the big banks like HDFC or the Kotak, or let it be the Axis Bank, they have increased their deposit rate somewhat in line with the lending rate, but the public sector banks are yet to catch up. So the whatever the margin expansion in terms of NIM margin going up in the previous quarter, which fueled the rally in the public sector banks, is not a structural one in our opinion, because deposit growth needs to catch up, and it is already visible in the couple of quarterly disclosures where the deposit growth is quite lagging for the public sector banks. So to raise the capital, they also need to increase the deposit rate. So the difference between the lending and the deposit rate for the public sector will come down in our opinion. So one needs to be very careful when one is looking at the BFSI side. One needs to pick with the banks which are not going to suffer from the NIM compression, because the fall in compression will also lead to the sharp fall in the stock price as well. So one needs to keep those things in mind. And of course, the valuation is one thing, but the growth is another thing. If we want to, let's say, create wealth for next 5-10 years, so one needs to pick the banks or the financial institutions like NBFCs, where they can grow their loan book, let's say north of 15% at least. Then only their profit will at least grow to 15%, and we can expect doubling of the profit or the doubling of the portfolio in next 5 years. So one needs to focus on these two sets, growth plus the NIM, when one is considering to invest the BFSI sector. Yeah.
Yeah, thank you, sir. So the next question is, how are you handling the volatility in the portfolios that you manage, and how to go about, deploying fresh investments from here on?
Yeah. Prabhat, would you like to take this one? Yeah, Prabhat, I think you are in mute. Yeah.
Yeah. So on the portfolio side, what we have done is in the year 2022, that mainly we have diversified the tail, right? So whenever there is a volatility in the market, we try to counter it by diversifying the tail. And by diversifying the tail, we mean is that we have added more number of stocks from various sectors, right? So what we have seen that some of the sectors which are not in sync and which are mostly impacted, sectors which have exposure to the crude last year. So that have not done well, right? So again, we have tried to find out some of the counter sectors and added in the portfolio. And again, since it's a diversified one, so when there is a downside volatility, the fall is much lesser, right? So that's the one thing we have done. And again, on the portfolio side, we were very prudent in booking the profits last year, right? So if you look at, we have booked profits until now, we have raised around 10 to 12% cash across the portfolios. So the current level of cash that we have is around 12% in large cap and the in the large cap and the multi cap portfolio. So that if there could be any volatility going ahead on account of budget or some sort of volatility coming from the downside in the US markets, right, or mainly from the earnings surprise, negative earnings surprise, so we will be able to deploy those the cash that we have raised in a very staggered manner. And thirdly, what we have done, we have picked out the names in the portfolio which don't have any past baggage, right? So by past baggage, I mean that we have a lot of IPOs have come last year, right? We didn't subscribe to much IPOs in the year 2021 when the IPOs were the companies were not having any profitable track record, and they were trading at exorbitant valuations. But last year, a few of the IPOs that have come, right, those are actually quite decent IPOs, and these companies don't have any any past track record to justify for, right? So when I say past record, so basically what happened in the year 2021, a lot of companies were trading at very exorbitant valuations, and for those companies, it got very difficult for them to justify the valuation numbers. Like in the year 2022. So basically, we had gone ahead and picked those companies, the recently listed ones, which have done very well, right? So as Vijay has highlighted, we picked one company from the women's wear brand, right side, that has been a good wealth creator for us in last year. Again, we took out a structural steel company, which had got recently listed on the exchange. So that has been again one of the best wealth creators for the calendar year 2022. So that way we have tried to find out a balance. We have allocated a certain portion of the portfolio, let's say 60-65% to the index names. And again, since we are a fundamentally bottom up stock picker, so we have kept around 35 to 40% weights for those companies where we are very sure of the future earnings growth prospect. And we can feel that when the market will rebound, these will be the future multi-baggers. So there we have tried to put our portfolio weights. Going forward, what we can feel is that market is since going to be bottom in 3 to 6 months. So we can look to deploy in a very staggered manner and be very selective in finding out the opportunities going forward, right? So 2021 was a macro year. If we have just followed the macro trends, like where the crude is moving or where the inflation print is coming up, what the Fed is talking about, so we would have been better off investing in that such kind of market, right? But year 2023 is going to be very selective in terms of a lot of stocks have already seen a very massive value erosion, right? If we are wrong in picking out the names, it will be again we have to wait out for at least next 1 to 2 years to at least break even in those names, right? But if we are able to find out the right names, so whenever the cycle turns, we have historically also seen that these are the first leg of companies which see massive re-rating, right? So 2023 is going to be a year where we will see new emerging leaders, as Vijay has highlighted, coming up, and we have to be very selective about it. So I think, that's our strategy going forward.
Yeah, thank you, sir. So the next question is on the valuation front. So Nifty is trading nearly 19x of 1 year forward earnings, and the Indian market is trading at a premium valuation. So do you think it is better to come to India for investments, or how do you see the funds playing out from here?
Yeah. So, so when we are looking at the India, so India's valuation is it's right that India is trading at a premium if we are comparing it with the other global markets, but our growth rate is also very better from the other GDP if we compare with the other global markets. And we have been very successful if we look at the nominal returns and also the inflation adjusted GDP growth rate. So if we look at the real returns, we are somewhat at the positive real returns. And if we look at the US positive returns, so that are still negative. They are bringing down their inflation, but they are not. They have a long road to go before they, let's say, break even the real interest rate side. So the premium will remain there. But as we are also the fundamental bottoms up stock picker, so for us, this volatility becomes a very good entry point for picking up the emerging leaders from the for the next bull cycle, which we did in the 2020. So just to give an example, so in 2020, when the market was down around 30-35% in mid and small cap space, we picked up a company called Solar API, which was an ibuprofen manufacturer. Again, this is just for the educational purpose, not any stock recommendation. So we almost entered at around 450 odd rupees, 1x price to book valuation. And we almost made around close to 2.7x, and we exited around 1100 odd rupees in a more or less 15 to 16 months only. So that is how we played the last bull cycle in the pharma space. So similarly, what we have done, we have already highlighted some of the leaders, and we have also identified more emerging leaders from the and started deploying in those names. And any volatility which will come from the global side, we will again deploy and increase our positions in those names. So a global part is one thing, but if we move past this recession fear and all the US Fed pivot, mainly from the US, whenever the US Fed starts to cut, or let's say the last rate hike, we can see a massive bull rally starting even in the global side as well. But India will still be able to outperform mainly because of the fundamental reasons, which are the higher GDP growth rate and the lower inflation. So I think we are far better off in long term versus the developed economies. Yeah.
Thank you, sir. So the next question is, what is your view on crude oil, and how will it benefit the economy? And then adding to that, how to go about gold allocation for the portfolios? Is it better to diversify at this point in time?
Yeah, so I'll just take the gold part and maybe Vijay can take the crude part, right? So, gold has been a very good natural hedge against equities, right? So whenever we are not sure of the equity market, how it's going to behave, so we can always look to have some sort of exposure there in the gold side. And actually, we have done it through our portfolios as well in the year 2020 when the markets were kind of very volatile. We were holding gold before that, right? And today also, if you look at in the FlexiCap portfolio, we hold certain portion of gold, but that's mainly because we are gold is never a long-term investment for us, right? It's just a tactical hedge. We don't want to hold a lot of cash on the portfolio, right? Let's say we don't want to hold 50% cash, 15% cash in the portfolio. So that's why we go and allocate some portion of that cash to the gold side so that it can also act as a proxy to the cash, and that will provide a natural hedge against the market volatilities, right? But being an individual investor, you should be very thoughtful about the tax bracket you are in, right? Because the taxation on the gold is always high, right? And secondly is that it's never going to be a very long-term kind of thing, right? So gold only behaves in a very specific set of environment when there is a uncertainty in the geopolitical front, when there is some black swan event happening like COVID, or we are in a situation which is currently, right, when the dollar index, right, if you look at the historical track record trend of gold versus the dollar index, so whenever the dollar index kinds of retraces, so that's the time when normally people move from one safe haven of dollar index dollars to the other safe haven of gold, right? So that's the time typically when the gold starts to perform well. And if in fact, if you look at the last year performance, gold was up, I think, around 15%, right, in last year. So it has given one leg of its performance. The next leg will come for sure in this year, right? But you have to be very tactical about cutting your position because we have seen that happening in the year 2021 as well, right? When analysts were predicting that gold will give 25-30% return, from there on it kinds of reverse its position, and it has yet to cross that previous peak, right? So you have to be very tactical when you go about investing in gold, right? As a asset diversification and asset location perspective, it makes sense to allocate some bit of percentage to the gold, be it 5%, 7%, 10%, depending your preference, your advice of your relationship manager. But if you are just investing in gold to diversify and seeing as a long-term investment option, that we won't recommend actually, right? So if you're investing, you have to be very tactical, very short-term oriented, that if you're getting some profit, you have to book that profit and get out of it, right? And again, if you're booking the profit in short term, then you have to pay higher taxes. So that's the thing with gold, right? So yeah. Yeah, Vijay can discuss about the Brent part, crude part.
Yeah.
Yeah.
So the crude oil in last year, it has touched almost a $120, $130 in the NYMEX and the Brent side. So we don't see it happening again. And whatever the disruption came from the crude side, it has also fueled the higher inventory, and which led to the collapse of the margins into the quality businesses or the value-added businesses. But now, thanks to the global supply chain easing and also the supply coming to the market, now the crude oil and other commodities have started to cool off, and they have significantly came below their level around $80-$85 of Brent. And if you look at the NYMEX, it's around $74-$75. So we don't expect it going back to again 130. But this has become actually a very good opportunity for us, as we have also diversified our crude oil sourcing at least our Indian economy level. So we are buying cheap oil from the Russia below $60. So it's a very good thing for us. So we don't see that macro risk coming from the crude oil side. It may go up to $90 or $100 based on the OPEC intervention to maintain the price. But unless there is some global new risk coming, it won't touch $120 or $130. So the industries which were impacted by these things were mainly the paint side, or let's the specialty chemical companies which are using benzene or other hydrocarbon chemicals, which are byproducts of the crude oil. So those were quite heavily impacted. So we think that those situation will reverse, and the paints will get the early benefit because they have a very low inventory cycle. So they keep on buying frequently the in small batches the crude fresh byproducts of the crude oil. So these industries will benefit shortly in short term very quickly, like paints and even the specialty chemicals which work on the long term contract basis. So for them the contracts normally renews at every 6 months level. So maybe a past contract can be at a higher price little bit, but maybe when the June contract, or let's say the when first half ends for the calendar year and when they renew the contract, so that can be a very good contract for them. So these two sectors which we think that will have disproportionate benefit. Also for the majority sectors like FMCG or any value-added players like building materials, they will get disproportionate. They will also get some benefit, not disproportionate one, because the transportation cost also remains some significant portion of their goods which they transport. So the transportation cost for those products will come down, and it will also naturally increase their margin. So this also there are some ancillary industry which can benefit from the crude oil downturn. Yeah.